You have money to invest, but you're nervous about the timing. Should you invest it all at once or spread it out over several months? This is the dollar cost averaging versus lump sum debate, and the answer might not be what you expect. Let's look at what the data actually says. A landmark Vanguard study analyzed market data going back to 1926 and found that lump sum investing beats dollar cost averaging about 68% of the time. On average, investing everything immediately produced returns that were 2.3% higher after 1 year. The reason is simple. Markets go up more often than they go down, so the sooner your money is fully invested, the more time it has to grow. Dollar cost averaging means investing a fixed amount of money at regular intervals, regardless of what the market is doing. For example, instead of investing $12,000 all at once, you invest $1,000 per month for 12 months. When prices are high, your 1,000 buys fewer shares. When prices dip, your 1,000 buys more. Over time, this averages out your purchase price and reduces the risk of investing everything at a peak. Lump sum investing means putting all your available money into the market immediately. If you receive a $10,000 bonus, an inheritance, or a tax refund, you invest the full amount on day one. The logic is that since the market trends upward over time, every day your money sits in cash is a day of potential growth you're missing. You're maximizing your time in the market. Lump sum wins in the majority of historical scenarios because markets tend to rise over time. If you invested a lump sum in the S&P 500 at almost any point in history and held for 10 plus years, you made money. The longer your time horizon, the less starting point matters. If you have a lump sum available and won't need it for at least 7 to 10 years, the math favors investing it all now. Dollar cost averaging outperforms during prolonged market downturns because you buy more shares at lower prices. It also wins psychologically. If the market drops 20% the week after you invest a lump sum, the emotional pain can lead to panic selling. DCA avoids that gut punch. If you know you'd lose sleep over a big market drop right after investing, DCA might keep you invested instead of pulling out at the worst possible time. In the 32% of cases where dollar cost averaging won, markets were declining or moving sideways during the investment period. If you happen to start investing right before a major downturn, DCA protects you by spreading your risk. But here's the problem. Nobody knows in advance when a downturn is coming. Choosing DCA because you think the market is about to crash is just another form of market timing. Here's something important to realize. If you're investing from each paycheck into your 401k or brokerage, you're already dollar cost averaging by default. You don't have a lump sum to invest. You're investing as you earn. That's completely fine and is the standard approach for most working investors. The lump sum versus DCA debate only applies when you have a large sum of money available all at once. If you have a lump sum and a long time horizon, the data says invest it now. But if the amount is large enough to make you anxious, split it into 3 or 4 chunks and invest over 2 to 3 months. You'll capture most of the benefit of lump sum investing while giving yourself a psychological safety net. The absolute worst option is to hold cash indefinitely, waiting for the perfect moment. That moment never comes. Whether you choose lump sum or dollar cost averaging, the most important thing is that you invest consistently and stay in the market long term. Subscribe for more evidence-based money breakdowns every week and watch my compound interest video to see how your investments grow over time.